Uh, Mr. Jayaraman, thank you very much for joining us in BQ Prime. We're going through a lot of volatility with respect to commodities. Then we had, you have consumption issues which are coming in. My first question to you is primarily on the consumption trend. How do you see the consumption trend in the last 6 months? Because we've crossed 2 quarters, and do you see a pickup happening in the second half?
Morning, good speaking to you. Consumption is a challenge. Okay, we have been facing now for 3 quarters of data. Maybe the current quarter, beginning October, is a critical quarter. The festive season will give us a sense of how it's shaping up. But consumption has been slowing down, and that's one of our key concerns. And when you slice and dice into the kind of consumption moderating impact that we see, I think it's a little cause for concern in the sense there is a challenge on mass consumption across categories, be it staples, be it automobiles, be it consumer durables, even e-commerce, or various categories of discretionary consumption, including QSRs or others. We are seeing volume growth moderate, okay, and that is a concern that we have. Pricing had gone up in the 12 months before this, so we did see companies benefit from the raw material prices, which eased up in the first 6-9 months of the financial year, or the last 6-9 months. But whether that sustains, whether that continues to give you earnings growth as we go into next calendar is a question. So consumption is something that we are quite watchful about, and watching data points which give us more confidence. And so far, we are not able to see data points contributing to pick up.
Mm-hmm. It's interesting because we have a case where consumption is sluggish in that nature, but we also have a case where we have started seeing private capex coming up in the last 2 quarters, 2 or 3 quarters. Now, if consumption is not going to be sustained going forward, the private capex which has been put in place or which is in motion, do you see some kind of slowdown happening in the private capex?
So, no, actually, that's where the picture is completely dichotomous, because private capex, we think, has started picking up, and we think it will further pick up over the next 12-18 months. When we see corporate balance sheets, when we see the kind of capex being planned, which is very import substitution in nature, not just domestic demand driven, the MNC-led capex, which is due to both the PLI as well as the whole China plus one angle, the MNC's moment confidence on India. So combination of all these things, private sector capex specifically should, in fact, pick up post-elections quite significantly, meaningfully. What we think can moderate or flatten out beyond the current year, beyond elections, is government capex, okay, which we think can step back vis-a-vis the last 2-3 years, where government's fiscal spend was a big impulse into the economy. That's likely to flatten out. So if consumption slows down, and if exports, including IT sector exports, are weak or flatten in that trajectory, and if government capex also flatten out, the key driver of the economy of earnings growth is the investment cycle, okay, especially private sector investment cycle, and that's something that we are watching pretty closely, and that to me is the most important driver of earnings growth or broader economic activity going in the next 18 months.
So what you're saying is basically the private capex that we have seen reviving is primarily because for exports or import substitution, which is coming into play, and not the organic demand which may come in because of the consumption theory or the which is based out. Is it?
It's both, but all I'm saying is it's not dependent only on domestic demand. It has legs beyond domestic demand. So in other words, what I'm saying is, even if domestic demand consumption were to moderate, our sense is managements will still want to expand capacity looking into the future, in the sense because it is import substitution and potential for exports adding to domestic demand, which gives them confidence to expand their capacities.
So within the capex space, private capex space, which are the sectors that you see where you've seen the maximum amount of capex coming in?
Renewables for sure, steel very likely, um, even alternate energy. We think post elections you'll see a lot of progress on that. These are the more capital intensive sectors, maybe some extent cement as well. So cement, steel, renewables, and the whole alternate energy, that's one area where that's the larger segments. Apart from this, the sectors such as the whole electronics, which is where the import substitution is going to be very very critical, or maybe beyond the next 18 months into segments like semiconductors and others. But electronics in general is where we continue to see very strong capex momentum. Those are not very capital intensive, but they have pretty high asset turns, so their impact on revenues will be quite high, but they are not very high upfront investment sectors.
Mm-hmm. If you look at some of the traditional sectors which are contributing in the banking and financial space, what is your view there, given the kind of interest rate cycle that we are at now? And we've seen some outperformance coming in banks in the last one or 2 years, but it's been little quiet in the last couple of quarters for banking. But how do you see the banking space turning out? Because if the capex cycle is going to come up, you will have to have more credit growth coming in, and will that be a good driver for banking sector?
So banks are a sector we remain positive about. Okay, apart from industrials, that these are the top two sectors where our positive stance is currently there. Specifically on banks, we think credit growth will remain healthy. There will be some bit of margin compression, which is happening for the last quarter or maybe 2 quarters, but we think that trend can sustain. But it's not going to be very worrisome. We don't see credit costs spike. So the broader point is banks have well provisioned income statements, maybe over provisioned income statements, and over capitalized balance sheets. So return on assets and return on equity both have potential for healthy trajectory over the next 24 to 36 months. So our confidence remains on various kinds of banks in that both PSU, large private, mid-cap private banks, various kinds of banks remain in our top picks.
Mm-hmm. What about housing finance companies? Because that's something which has been some of the mid-cap housing finance companies are something which have been moving around. What's your view on that?
We are not as positive on NBFCs as we are on banks. We think the AAA NBFCs can benefit, but the others can see cost of funds impacting margins. And our view on the macro is also that if oil remains around 90 and if exports are going to decline, the second half and FY25 current account deficit will be putting the whole banking sector liquidity to risk. How the central bank wakes up and reacts to it on the currency front, on interest rate front, we are not very positive on the broader macro. So more caution on NBFCs, but we think that environment is actually good for bank margins.
On that point, how do you think the central bank is going to do tomorrow when it meets the monetary policy?
I'm not very good at predicting this, but generally I will expect no rate hikes, but kind of a cautious or a tone suggesting that inflation is still challenge, and the rupee pressures could be could be keeping them wide even at night. So the tone of their commentary will make markets not get too confident on the outlook. But
Do,
no rate hikes.
do you
That's my
think
view.
the RBI will moderate the growth rate as well, given the kind of
I think so.
consumption?
We think so.
Okay. Coming to the IT sector, because you've been talking about IT as well. How do you see this entire thing panning out? Because at one point in time, it was the most overweight for many, but in the last 2 years, people have been, neutral to underweight. We've seen the maximum outflows of foreign money going from this sector, $15 billion in the last 2 years or 3 years, which has flown out of it. How do you see the IT coming in, and is there a way to look at IT from a point of view of the kind of margins they are sitting on, or the growth rate they are going to look at going forward?
No, we remain cautious on IT. We have been cautious on IT for more than 2 years now, and we remain so. It's a large underweight recommendation from us on the sector, and we hold on to that view. We think the constant currency growth will moderate. There are some signs of pricing pressure which has started more recently. We are keeping a watch on that. The silver lining is on the rupee. Okay, for them, if the rupee depreciates, it could offset some of these top line related pressures. But the way we've always seen, the rupee is a reason number 5. Okay, it is never reason 1, 2, 3, 4. Okay, and our concerns are 1, 2, 3, 4 look a little negative, so we remain cautious on IT.
Mm-hmm. Interesting. I was looking at one of your reports, and it mentioned that while personal loan growth has been healthy, personal consumption has been weak. How do you bring both of them together and give us a sense of what exactly is happening?
That's a puzzle. I mean, I've never seen 28, 30% unsecured personal loan growth, or most categories of retail loans growing, not on a low base, but on actually a pretty good base. It's growing reasonably high. With that base, what we should have not seen is the slowing down of household consumption across categories, which I mentioned. So, where is the money going? Is it going into servicing debt? That's the question that we are asking. Is it also finding its way indirectly into markets through retail flows? That's another question that we don't have answers, but we are watching and we are trying to assess if that is indeed the case. But long story short, this dichotomy between credit growth on retail loans across categories and the overall consumption moderation is something that we need to be very much watchful about.
Now, your assumption on whether this unsecured loans which have been taken is flowing into the markets is a very big red flag, right? Because the moment returns start going negative, you're going to have a bigger issue with respect to unsecured loans if this fund is actually going into markets.
I don't have data to say that it is indeed going, okay, but I am trying to assess if that is potentially, anecdotally, is it happening or not? We need to assess. But basic question is, if credit growth into retail loans are good, but retail consumption isn't picking up, where is the money going?
And retail household savings is also coming down. So in
It's net saving, net of liability. So
net of liability. So it's
that's the point.
Yeah, and there is no way you can put a finger there and say, okay, what is the issue? Is it a fact that they are looking at more discretionary spends using unsecured loans?
So we need to see, that's something for sure. About 20, maybe 25% of unsecured personal loans are going into travel and tourism. Okay? Mm-hmm. And that we are seeing in hotel occupancy or airports or flight or occupancy or thereabouts. We are for sure seeing on about a fourth to a fifth of the unsecured personal loans. But in absolute terms, over the last 12 months, unsecured personal loans grew about 2.75 lakh crores from just banks. Then how much from NBFCs, I don't have accurate data, but from banks alone, it's 2.75 lakh crores. So it's a pretty large number on credit growth without commensurate pickup in demand in other categories.
Mm-hmm. Mike, next one was on the capex cycle. We briefly spoke about the fact that the public sector capex may slow down post FY24 because there may not be enough room with the government. Do you see the private sector capex, which is now picking up or catching momentum, able to replace the public sector capex and hence the investment cycle continues?
We think so because when we study the BSE 500 companies' balance sheets, the kind of cash flows they generate available for capex, the kind of capex that they have been doing, we think there is room for companies to grow their capex, and that will be a driver. And then the unlisted MNCs, you just see the number of global CEOs who have come to India just in the last 3 months. Unless they have some plans to expand quite aggressively in India, why will they come? Okay, and we are watching it on the ground as well. MNCs looking at India for expanding, be it for selling here or for as a source of exports, services, and merchandise. Okay, keep that in mind. The captives, the global capability centers of some of the largest banks or even others are now so high that the employee base in India is possibly more than almost a fifth of their global employee base. That's on services, and then the manufacturing side, if the beeline which we are seeing, especially on electronics and even some semiconductors, we are seeing some early signs. It will take time, but we are seeing some pretty good progress on this front. So the sector where we have our most confidence going into the medium term, next 18 odd months, is actually clearly private sector capex.
Mm-hmm. You're betting big on private sector capex, but private sector consumption is not picking up. Do you think at some point in time, it will be converging towards a particular growth rate, both of them, with either the consumption has to go up to meet the private sector capex, or the private sector capex has to, moderate itself to meet the consumption? So, do you think that will happen sooner?
So it will take time. We think it will take about 18 months typically for the current momentum on planned capex, which will it's reflecting currently in order books, into project sanctions or approvals, I say by environmental clearances, or these are all lead indicators, right? For them to actually translate into actual spend on the ground, credit growth to happen, that spend converting into hiring and wages, that higher wages and hiring converting into consumption, it is an 18-month plus cycle. It takes time. Okay, it doesn't happen seamlessly. So yeah, your point is right that if the capex cycle happens, it will lead to eventually consumption to pick up, but it's not going to happen overnight.
Mm-hmm. My next question is basically that if these are the setups which are there in macro level, how do you filter it down to a micro, and is there specific themes that you're chasing, and within that, how do you see the Nifty earnings playing out?
So, as I said, right, if consumption is going to continue slowing down, if exports remain maybe flat at best, or maybe double digit, or maybe high single digits year-on-year decline, and going into next year, if the government capex is going to be flatter, trajectory, then we need to be a little watchful of broader level earnings growth expectations. And if the macro on the current account and liquidity and all these, you need to keep that into consideration and not be uber bullish expecting 20% earnings growth. Okay, we will see downgrades. So what, in other words, we are saying is, when we are recommending stocks, when we are telling investors to buy, we will urge them to say, build some room for error, build some margin of safety, some safety net in terms of earnings expectations, in terms of valuations expectations. What kind of managements do well when the tailwinds are lesser? We need to keep in mind. Many managements do well when there are very strong tailwinds, but very few do well when those tailwinds stop. So, in other words, what we are saying is managements who have a track record of delivering performance across cycles, we need to start looking at them. They have actually underperformed in the last 12, 18 months. Many of them, across sectors. Some in banks, some in consumer, some in industrial cement or even pharma. So start looking at the managements who have a track record of performing across cycles, and that's one. Second is, as I said, sectors with tailwinds, which is basically the industrials and some banks. So I would have also said, we were saying maybe 3 months back, 6 months back, that sectors which have underperformed, if there are the best companies in them, like in life insurance, or it could be in two-wheelers, it could be in even in some pharma. But last 3-4 months, even they've rallied. Okay, so the pockets of underperforming sectors are now almost non-existent. So that leaves you with option to go for the quality management and sectors with tailwinds, which is industrials and some banks. That's where our recommended set of stocks to clients, our top picks, are veering towards.
Mm-hmm. And what was the kind of nifty earnings growth that you penciled in the beginning of April, and what is it now, given the fact that you have all those, headwinds coming in, or as you mentioned, the 1, 2, 3, 4 is looking very bad. The fifth one is not so bad, but how the 1, 2, 3, 4 factors which you have spoken about, impact the earnings growth?
So ex financials, it should be about early teens, including financials, it should be late teens. But financials have a lag impact of some of these macro plays into earnings with a 6-9 month lag. So next year, we are still looking at early teens earnings growth with some risk on downgrades.
Mm-hmm.
It's actually not FY24 earnings that we are worried about. It's FY25 earnings, which means the multiples is something that we need to watch, and FY25 earnings.
What clearly comes out is that financials, banks and financials are something going to be a safe haven going into FY25 as well, right?
Looks so.
And so many will be betting big on the banking side, and maybe consumption and other sectors may take a back seat, and some downgrades may happen in other sectors. Oil and
Very
gas.
likely, especially in exports and consuming sectors, some consumer related sectors, we should see some downgrades. But industrials can continue to show pretty strong order book or lead indicators to earnings growth momentum.
Mm-hmm. Because industrials have been showing good order book growth. Now it's growing to 2-3 years order book, which is there, especially in defense sector, which is there.
The only challenge on that is the Jan, Feb, March is usually the quarter where the highest order book momentum is demonstrated. In the current financial year, it will be the quarter lead up to elections. So many will defer their order books into wait and watch till elections mode. So we might see a year-on-year decline in order books in that quarter, and that can kind of give us some jitters.
Mm-hmm. The JFM quarter may be slow on order book booking. Basically, that's what you're saying.
Yeah.
Ganeshram Jayaraman, thank you very much for joining us on BQ Prime and talking to us. That was Ganeshram Jayaraman, Managing Director and Head of Institutional Equities at Avendus, giving us a perspective from macro and micro levels. Thank you for watching BQ Prime.